All right, so let's start with the big one. What are interest rates in today's market, April 1st, 2026, and what can buyers expect when they get that pre-approval letter?
So rates are coming down. I think that in the last couple of weeks they've come up because of the whole war in Iran. But I think rates are coming down. We see the light at the end of the tunnel, and so I think that they are starting to trail down.
What does that mean for somebody who has fair credit, fair income? Should they expect a 5.5, a 6.5, 6, where it's kind of the average?
Yeah, okay, rates take a lot into consideration, right? They take credit, debt to income, down payment, all that stuff. So they get your entire picture and they spit out a rate. More risk equals higher rate. So like right now, let's say for an FHA loan, you're probably thinking about, I don't know, like a 5.75, something like that.
All right, good deal. And how does credit actually affect the rate?
High risk, higher rate, right? So like you wouldn't lend money to somebody that you don't think will pay you back, right? And
For
so
sure.
what that credit score does is the higher the credit is, they prove that they have paid on time every time for an extended amount of time.
Good deal. I'm Jose Trevino, your local Denton Realtor, and I'm here today with Joel Madrid, our preferred lender right here in Denton, Texas. We're going to get back to the podcast, but before we do, just make sure and hit that subscribe button and follow along so you get content as soon as we produce it. Let's jump back in. And I've seen some people, from a listing agent perspective, I've seen somebody submit offers with a pre-qualification letter, and then I've also seen other people issue a pre-approval letter. What's the difference, and which one should buyers be doing in today's market?
So I'll tell you the difference. You can tell me what's stronger, right? So the difference is a underwriter has seen the documentation on a pre-approval. On a pre-qualification, the loan officer sees the documentation. In some cases, they don't even do that. They don't even go that far. But what we do is we put eyes on the documentation, verify income, verify assets. Without sending it to an underwriter, we pre-qualify them. Now, whenever it comes on the listing side, what do you think? What do you think is a stronger offer?
Definitely the pre-approval, because from my perspective, I just kind of figured that a pre-qualification means somebody has submitted an application. They might say that they make X amount per year and they only have certain debts, and then it spits out a pre-qualification. I always thought that a pre-approval means that they've actually submitted documentation, W-2s, tax returns, check stubs, bank account information, all that stuff, so that somebody can look at it before we get that pre-approval.
Yeah, so pre-qualification, we actually ask for the documentation, but there's a lot of people out there that they go strictly off of what the application says. So if the guy is a janitor, says he makes $300,000 a year and has $100,000 in his bank account, they'll give him a pre-qualification, but that's not the case, right?
Yeah, for sure.
So it's kind of tough to go off of what some people do pre-qualifications off of.
Good deal. And let's talk about closing costs. What's all included in closing costs, and are those negotiable? Who pays for them? Where that money comes from? Because a lot of people think that all I need is my down payment, and that couldn't be further from the truth.
Yeah, so there's a lot that goes into closing costs. You have title fees, you have lender fees, which are like points. Points are what we use to lower the interest rate. The escrow fees, you have to get a whole year's worth of insurance. You have to prepare to pay your taxes whenever they're due. You have to have 3 months of reserve or 2 months of reserve and 1 month that you're not. There's a lot that goes in there. What you can expect to pay is about 2.25 of the sales price in closing costs. Now, as far as they're negotiable or not, that's more of a you question.
Right. Yeah, so in today's market, we're asking for closing costs to be covered almost on every single deal, unless it's just a slam dunk where the property is priced really, really well. We're asking the seller to at least contribute part, if not all, closing costs. So
yeah, on average, how much closing costs do you think you get on a deal?
Well, we're a little aggressive, so I would say we typically try to get our buyers all their closing costs covered so that they're only coming out of pocket their down payment Sometimes we're able to do that. Sometimes we're even able to get extra where they can actually buy down their interest rate and things like that. And then there's other times where there's a little bit more competition, the property's priced a little bit better, and we can only get about 50% of the closing costs covered. But I would say anywhere between $5,000 and $10,000 is what we're consistently seeing today.
That's great. And there are pros and cons to everything. What are the cons to asking for too many closing costs?
Really, the only con I would say is that after we do the home inspection, if there's issues, we've already exhausted all the concessions that we can get. So we're not able to get money back to fix those issues. We actually just have to ask for the repairs to be done.
Gotcha.
And sometimes that's not the best thing to do. Sometimes we want to do those repairs ourselves after closing. So that's really the only con I would say.
Yeah, and also your offer not being accepted, right? It's kind of tough getting an offer accepted. If it's a hot property and you have multiple offers, you'd want to definitely not offer or not request as many closing costs.
Yeah, for sure. I mean, that's asking for concessions, asking for closing costs is reducing the amount of money that the seller's going to make. So if it is a hot property priced really well, and there's multiple offers and we know it, then yeah, we got to kind of back off the concessions. But we can always structure the deal differently if our buyer needs closing costs. We can offer a little bit more so that that's rolled into the loan and the seller still gets what they need, so we can get that offer accepted.
I've seen a lot of people get confused of where those closing costs are coming from, right? So I've always gone, okay, so we're going to raise the loan amount or we're going to raise the offer so we can offset those closing costs. I get this question a lot. Who's paying for those closing costs, right? So in that situation, who's really paying for those closing costs?
Well, the seller is technically paying for the closing costs, but they're also getting a higher amount on the offer. So in a sense, the buyer's paying for it by giving more money to the seller.
But financed, right? So it doesn't necessarily come out of their pocket. And so I think that cash to close is the biggest hurdle to home ownership.
For sure.
Right? So people are usually, they shop within their means, but the amount of money that you have to come up with is always the biggest hurdle in my experience, right? So if you can lower that, I think that is invaluable, man.
Always a win. We always talk to our buyers before we even start looking at houses and find out what is their biggest hurdle. What are they looking to accomplish? Is it they want a home at a certain purchase price and they're fixed on that? Are they fixed on a monthly payment?
Gotcha.
Or are they strapped when it comes to cash to close? If they're strapped when it comes to cash to close, meaning they only have a certain amount, we know how to structure the deal so that they only spend what they have and they can get into a home.
Sure, yeah, and also down payment assistance.
For sure.
We can always offer something like that. I mean, in some cases, we've gotten people into houses for less than what they could get into a rental house.
Oh, yeah.
Because you got to give them first month's rent, security deposit, and that stuff adds up.
For sure. Let's end this thing with this last question. If somebody's thinking about buying, but they're, let's just say 6 to 9 months out, maybe they don't even know where their credit is at, or maybe they know that it's not the best and they want to start saving money and planning ahead. What are some things that they can do right now to plan correctly?
Reach out. I mean, so the main thing is let an expert work with you on your credit. I've been working with credit. I'm the expert. So I've been working with credit for 17 years. I know all the tricks to the trade. I know how to get there quick. It's tough to say get there quick just because whenever you're going to affect credit score, you either have to have time or money, right? So if you don't have a lot of time, you got to have a lot of money. If you don't have a lot of money, you have to have a lot of time. But there are some shortcuts that we know and that we picked up along the way that would definitely help them get there quick.
For sure. So if that's you, if you're planning on buying a home in the next 3, 6, 9 months, reach out to our team. We'd love to help guide you through the process so that when you're ready, we can help. Appreciate your time, Joel. We'll see you on the next one.
Yeah, for sure.